Most people have heard that investing is the best way to build wealth, but very few actually understand how it works. At its core, investing means giving up a little today so your money can create more money in the future. Instead of spending every dollar you earn, you put some of it to work, with the goal of earning income or profit over time. That's exactly how the wealthiest people in the world built their fortunes. They didn't just earn money, they invested it wisely. So let's break down the most common ways people invest, starting with stocks. A stock represents ownership in a public company. When you buy a stock, you own a small piece of that business. Stocks can be risky because prices move up and down, sometimes very quickly. But with higher risk comes the potential for higher rewards. There are two main ways stockholders make money. First, dividends. These are portions of a company's profits paid out to shareholders, usually 4 times a year. The more profitable the company, the larger the dividend tends to be. Second, capital gains. This happens when you sell a stock for more than you paid for it. If you sell for less, that's called a capital loss. Stocks are bought and sold on stock exchanges, and today, almost anyone can access them instantly through brokerage apps on their phone. Now, let's talk about bonds. A bond is essentially an IOU. When you buy a bond, you're lending money to a company or a government in exchange for a guaranteed repayment at a future date. Bonds are generally more stable than stocks, but they usually offer lower returns. Every bond has 3 key features: the coupon rate, which is the interest paid to the bondholder; the maturity date, which is when the bond is repaid; and the par value, which is the amount you receive when the bond matures. For investing to work on a large scale, an economy needs a financial system, a network that connects people who save money with people who need to borrow it. Most savers don't lend money directly. Instead, financial intermediaries step in. These are institutions that move money from savers to borrowers. Banks are one example, but there are others, like mutual funds, hedge funds, and pension funds. A mutual fund pools money from many investors and spreads it across a variety of stocks, bonds, and other assets. This diversification helps reduce risk. A hedge fund is a private investment firm that uses more aggressive and risky strategies. These are typically available only to wealthy, experienced investors. A pension fund provides income to workers after retirement. Employers collect contributions over time, and professional managers invest that money in financial markets. One of the most important investing principles is diversification. Spreading your money across different investments lowers risk, especially during market downturns. Smart investors balance higher risk assets with more stable ones. Another critical factor is time. The earlier you invest, the more powerful your results can be. Because of compound interest, simple interest only earns returns on the original amount invested. Compound interest earns returns on both the original investment and the interest it has already earned, often called interest on interest. Here's why that matters. If you invest $10,000 at 5% simple interest for 5 years, you earn $2,500 in interest. But if that same $10,000 earns 5% compound interest, and seksin biyam, amanadanman, andaindruro. Especially if it compounds monthly, you earn significantly more over the same time period. That difference grows larger the longer your money stays invested. This is why compound interest is one of the most powerful forces in investing, and why patience matters more than timing the market. At the end of the day, every investment involves a trade-off between risk and reward. Generally, higher potential returns come with higher risk. Understanding this balance is the foundation of smart investing, and it's what separates long-term winners from short-term mistakes.